Good afternoon, everyone. My name is Marc Boiron. I'm a partner at Fisher Broyles in our blockchain and fintech practice. So we'll be talking about compliance, accounting, and record-keeping issues. With me here are Alexandra Damsker, Sergei Mytko, and Justin Newton, and I'll let them introduce themselves.
Hi, I'm Alexandra Damsker. I am an advisor for Vertalo, and I'm a securities attorney, a founder, and I used to work at the SEC.
Great. I'm Sergei Mytko. I'm a managing director with Crow LLP. I specialize in advising global companies on their international operations. And for the past few years, I've been working with a number of both ICO and STO companies and addressing their international and domestic tax issues.
Cool. Hi, I'm Justin Newton, the founder and CEO at NetKey. We help companies that are working inside of the blockchain, crypto, security token space with their customer onboarding around KYC, AML, counterterrorism financing, kind of all that fun and exciting stuff. We've worked with a couple of dozen different issuers, platforms, exchanges, et cetera, to help them really shore up that portion of their business.
Cool. We kind of heard from the SEC last week with its kind of digital assets framework and that no action letter. And different people have views on the usefulness of that guidance. But generally speaking, what I think everybody agrees on is that we got a very conservative view on what might not be a security, which leaves a whole lot of room for things that will be securities and kind of different types of assets that might fall into that bucket and how they might be treated for compliance purposes as well as accounting. So maybe first we could talk about, given how broad kind of the security token world is, from a legal, tax, KYC, AML perspective, how are things different just in general at a high level for when you're dealing with security tokens?
Versus utility tokens, or what?
Versus traditional securities.
So I think the first thing is that I don't think people realize necessarily the breadth of the framework that exists once you are in the securities realm. The second issue is that there's a fairly clear bifurcation in the guidance that we've been given that the type of digital asset you are actually determines which system you're going to be governed under. If you are an altcoin, you are more likely to be governed through the Treasury, and if you are more of a token, then you are more likely to be governed through the interpretations of the SEC and to some extent the CFTC. So I think that the first thing is to realize that you're governed by a set of regulations and not exempt from them. And then the second is to figure out which set of regulations you're more likely to fall under, and that you can go back and forth over time. You can have a digital asset that is not considered a security initially or will be deemed not a security later, so they can actually change over time versus more traditional securities which maintain their status throughout their life.
Great.
From a tax perspective,
sure.
How do you approach things differently?
Yep. For tax purposes, actually, the characterization as a security for securities laws purposes doesn't have that much impact, but it's still a question of characterization. For tax purposes, if an instrument is treated as your security token, there's a possibility that it'll be treated as equity for tax purposes and may offer significant advantages to the issuer, unlike what we've seen in a number of ICOs. Security token proceeds could be treated as tax-free receipts for purposes of U.S. taxation as well as in a number of other jurisdictions. So for the issuer, clear advantages. Also from the perspective of investors and employees of the issuer, the fact that this is a security or maybe equity for tax purposes, it could be beneficial as they may benefit from certain elections as well as from certain tax-free treatment of certain exchanges.
So from my side, I guess maybe I'll do comparisons from two different perspectives. First, just really briefly, hitting on some of the difference between ICOs and STOs from a compliance perspective, and then also traditional securities.
That'd be great.
You know, from ICOs and STOs, I think that really when you dig into AML and KYC, at the end of the day, the requirements are fairly similar. However, when you're dealing in the security world, compliance is actually part of the product versus something that's bolted on the outside of the product, because you're never going to be able to create or issue a security until the compliance aspects of both the initial issuance and ongoing secondary market trading of that security are appropriately addressed. So, you know, it's really part of the upfront planning of the process before you're really even thinking about anything else. In terms of the difference between, you know, anti-money laundering requirements around, say, a traditional security and a digital security, the biggest difference that you run into is as soon as you're dealing with freely tradable and freely movable digital assets, you immediately are in the high-risk category when it comes to things like anti-money laundering or counterterrorism financing. You know, and to just think about that from a simple perspective, you know, we hear very little about the drug cartels carrying stacks of Apple certificates, stock certificates back and forth across the border as a way to move money. And so it's not considered a high-risk way, you know, with respect to money laundering or terrorism financing or things like that. Crypto assets, on the other hand, because they're globally liquid and globally tradable, and they can be moved in some cases without a third party's permission, immediately become considered high risk. So if you're onboarding people into a crypto asset that can move out of controlled wallets or controlled exchanges, then that asset itself is immediately high risk from an AML perspective. So you need to have a very high level of onboarding and compliance requirements around it. And similarly, if people are investing in your security using a digital asset as the source of funds, you need to treat that as if they showed up at your office with a satchel full of cash, and do the same kinds of checks and source of funds as if, you know, they'd showed up at your door with a briefcase with $500,000 in it, which is really different than a wire transfer that you got via $500,000. Because if you got a $500,000 wire transfer, the bank it came from already did at least some diligence around what those source of funds was and made sense. If they show up with a satchel full of cash, you don't know where it came from. Similarly with a satchel full of crypto assets. So it leads to those differences.
So when you talk about crypto assets and the liquidity related to them, are you talking about utility tokens in terms of crypto assets, or are you equally concerned about security tokens that the day that we actually have them in terms of having immediate liquidity? Are you as concerned about those?
So I think that for security tokens that are issued under US regulations, there will very likely be requirements built into the token itself or other aspects of managing the trading of the token that will reduce that risk, right? You know, securities will sit inside of a framework that does that. If someone tried to issue a security token as just like an ERC20 token that can just bop around anywhere, then yeah, absolutely, that would still be considered a very high-risk asset. And probably similarly, the SEC would be pretty mad at the issuer due to the fact that they would have lost control of their secondary market if that happened.
Sure. All right. So in the utility token context, we had a lot of kind of regulatory arbitrage going on, and kind of the global kind of ecosystem became way more one than you've kind of really ever seen before. And there was a lot of US founders going offshore looking for better jurisdictions to issue tokens from. What are you seeing in terms of, from a security tokens perspective? How should you be thinking about it internationally? I mean, is there as much desire to move outside of the US for security tokens, and if so, why?
So it's kind of a mixed bag right now. I see a number of companies wanting to incorporate or do offshore sales as opposed to necessarily staying when you would sell. If you're a U.S. company, you would generally initially start selling in the U.S. And the problem is most of them, as far as we can tell, seem to be looking overseas not for a beneficial jurisdiction in terms of evading securities regulations. And the problem is it's very difficult, unless you are entirely offshore, it is very difficult for you to truly evade U.S. oversight. We have actually one of the strongest SEC periods, so it fluctuates between somewhat of a weak SEC to somewhat of a strong SEC, and the SEC right now is fairly strong, as we saw in one broker, where you had a Marshall Islands company that was selling they had an open website that said, if you're interested in purchasing on our exchange, then please, let us know. And because it was open, it wasn't blocked to U.S. investors, and it wasn't even a U.S. company, the SEC got the FBI to shut down that company simply through a loophole that they had. So it's very strong right now. I think that the idea of trying to evade the securities laws is weakening to some extent. I think people are finally seeing that going to an outside jurisdiction to try and operate there isn't necessarily beneficial and doesn't necessarily get you as much funding. There are ways to insulate your liability without having to move all of your operations offshore. You can actually do quite a few things to insulate your liability without that. And in terms of operations, I think people look at the U.S. as a source of fairly generous funding. Although I do see a lot going offshore still to Asia. There's some in Canada. And there are a few other jurisdictions that seem to be havens for a lot of people. There are some set crypto havens and crypto hells, relatively speaking. They actually reject anything that is crypto related. The one interesting thing has been that most of the jurisdictions are sort of coming online with U.S. jurisdictions. So if you are deemed a U.S. security, or likely to be a U.S. security, often they will regulate you as though you were already a security. So there's less and less protection in strictly going overseas. There are some securities exemptions in doing your offering overseas. I still see a lot of that. And there are some tax benefits, which I'm sure we'll hear about later, that you hear that exist in operating in other jurisdictions. But I think strictly in terms of what we saw during, the big ICO boom, I think that's cooled a lot, and I think that's for the best. So.
Do you think that an issuer who is looking internationally and considering the U.S., is there really significant risk to them if they say, I am issuing a security, and it's a security token, but I'm going to stay in the U.S. and I'm going to issue it here? Do they really have much risk?
Well, they have the same risk as if they were issuing a security. I think that the one thing the SEC has told us over and over again is you don't have an exemption. You should actually, you are liable under the securities regulations. You operate under the securities regulations. And in my opinion, that's great because we know how they work. So I think that all the work and cost that it takes to try and evade the securities regulations really isn't worth it. I think that most companies are finding that if they are staying in the U.S., they're not facing any additional liability other than if they had issued a regular security. They were issuing just stock instead. So they have more flexibility than they would if they were issuing one simple type of traditional security. And they're able to do an offering here that's generally accepted overseas. So the other issue that exists is that right now the jurisdictional system over anything blockchain is a patchwork system that's inherited from traditional law. So you have a lot of conflict of laws issues that happen when you have, say, a company based in Cyprus, and then you have a buyer of a security in the U.S. and a seller in Switzerland, and then maybe it was mined in China, and something goes wrong, whether willfully or accidentally. Where does the liability lie? The benefit of being in the U.S. is that often they'll just give it straight U.S. jurisdiction. You have a lot more predictability of what the outcome will be and how to protect against it.
Sergei, what about from your perspective?
From my perspective, even though there's used to be some clear advantages with a foreign structure, given the fact that a number of issuers were looking to avoid current taxation on the issuance of their tokens, whether the utility of security. But I guess security tokens in the U.S. currently, depending on how they're structured, there's a possibility to structure them to be treated, again, as equity and have non-recognition for tax purposes on the proceeds of your issuance. So that's the big change compared to the utility tokens. On the other hand, there could be advantages, depending on the business model of each individual issuer, to go overseas if under a couple different circumstances. First, if you have significant customer base that's outside the U.S. and you want to benefit from potential lower rate of tax on your foreign operation, that will be the issue as well. And there are a number of countries that will apply a similar rule to the proceeds and treat them as non-taxable receipts of non-income. And the other part is what happens during the operation of the business. So if you have a U.S. issuer, domestic corporation, obviously the normal domestic tax rules will apply. And so, aside from the issuance itself, you might want to think about what's going to happen to your taxable income that you're going to be earning here in the U.S. Versus having a true offshore business where you might be paying much lower level of tax. Other considerations to keep in mind is also your future ownership structure. Are you going to have many foreign investors or investors outside the U.S. that will be holding your security tokens? So if that is the case, you should seriously consider whether an offshore structure would be a better alternative for you, because then you can set up an entity in a lower tax jurisdiction, potentially not to have to pay currently taxes in the U.S. as well. So there's, again, you have to balance all the risks and all the benefits of having an offshore structure. I think for many companies that are mostly domestic, the advantages have diminished to some extent, but for true international companies, there's still a lot of benefits that you can take advantage of from foreign structure.
How important is it for companies to get the tax structuring right up front? So if somebody says, "Hey, I'm going to form this entity, offshore," and then needs to bring it back into the U.S. for various reasons, or vice versa,
Sure.
Is that a big issue from a tax perspective?
Yeah, I think it's quite important, because I think what could happen if you start building up your business and you discover that you have a lot of customers outside the U.S., you develop your valuable intangible property or IP here in the U.S., and then you decide that I actually want to migrate my business model overseas and have my main center of operations somewhere outside the U.S., you could potentially get stuck with a sizable tax bill on your outbound transfer of your intangibles. So upfront tax planning is very important.
Yeah. And then Netkey, you guys operate on a global basis, so how do you think about things differently?
We definitely do. We work with customers from all over the globe and investors from pretty much every country out there. When you look at the compliance aspect around the KYC and AML, most of it is pretty similar to what Alexandra said, so I'll keep it fairly brief. But really what you need to look at is two things, both what is the jurisdiction that you're operating out of, because obviously you need to follow all of their laws, but then also what are the jurisdictions that your investors come from? Because, just again, very similar to what Alexandra said, if you have one U.S. investor, then, U.S. anti-money laundering and know your customer laws apply to you broadly across everything. And so, saying that your company is in the BVI or the Bahamas or UAE or Zug or wherever it is that you want to be, doesn't really change the fact that if there are U.S. dollars or U.S. people that are interacting with your investment, then it's very likely that you're going to fall under U.S. jurisdiction and U.S. rules. And so trying to do jurisdictional arbitrage probably is going to end up being more time and effort for less benefit than you expect when you get to the end of the chain.
Yeah, interesting. And the other thing that I think everybody knows, and one of the benefits of security tokens is the idea of obviously getting liquidity in the secondary markets, something that you don't really deal with traditional securities, but obviously we've seen with utility tokens. So when we're dealing with security tokens, how are you thinking about things in the secondary market? Obviously, from a legal perspective, it's going to depend on the type of offering that you're doing. But what are you telling clients in terms of what they should be doing when thinking about the secondary markets?
In terms of developing their secondary markets, or in terms of
from a legal perspective, in terms of what do you need to do from a compliance perspective?
So I think the biggest problem right now is the state of exchanges. So there are two diverging schools that are happening right now, I think. One are the people who are going with there are some companies right now that are helping to develop a lockup procedure so that if your token simply cannot be traded within 12 months of your purchase, and that will keep you from running afoul of the of a lot of the secondary market transactions if you're selling to accredited investors. The issue there is that that's actually more than the regulations require. They only require you to do 12 months total. You can actually conduct private transactions that are within that period to someone who could step into your shoes, so another accredited investor. If you're willing to do the KYC AML on that person, then you're actually able to sell sooner. So there's a question of whether or not this technology is actually at the point where you have an option of unlocking early if certain conditions are met. The second, of course, is secondary markets through what people call exchanges, but really aren't exchanges. They're ATSs or ECNs, and they are largely problematic right now for several reasons. One is tape painting is very common. There's a lot of false trading that happens, and then the biggest problem is that there's no compliance. So one of the reasons that creating and trading on an exchange is so expensive is because it's required to have an entire compliance division oversight in terms of its own actions and the actions of the companies that want to trade on it. And it has specific requirements that must be met before they're allowed to trade on them. And what we see now is a lot of exchanges, but really just trading systems that are trying to operate without that. And if they are operating in the chain of distribution and they are not doing it correctly, not only do they face liability, but the issuer faces liability. I think that's one thing that everybody needs to keep in mind. And what I try to encourage is that if you're just trying to put steps in to get them to a retail investor and evade the regulations, that usually isn't sufficient because you're just passing along liability to everybody in the chain. And if you choose to work with somebody who isn't compliant and you have anything to do with any of, not just the US, I mean, Switzerland, a lot of these jurisdictions have put in a lot of compliance that are similar to, and in a few cases, a little bit more severe than the US. If you try to do that, then you're going to be essentially liable for problems with that exchange. And the SEC has already gone after their primary targets right now appear to be hedge funds and exchanges, and part of that is because they can just open them up and see the companies inside. It's like a giant basket of liability that they're able to look at. So I would just say be cautious when you're looking at how you're going to conduct your secondary transactions, and really think about the fact that you're dealing with something that is a security, but at this point doesn't even have as many venues for liquidity, although those are coming.
Do you, on that last point, for liquidity, do you feel that regulations need to change so that we can achieve the type of liquidity that everyone wants to see in the secondary market?
I don't think that it's the regulations. I think it's the expectations of the people who are involved. I think that the idea that you can essentially have something that you can freely trade without it representing anything tangible is an idea that we just have to leave behind. This is not going to happen. I mean, really what we're looking at is creating systems that don't necessarily have to have the trading volume of like NASDAQ as yet. But I think what they need to do is first they're going to consolidate. So all of these small exchanges all over the place will consolidate. And then once there's some compliance involved, and there are exchanges, even NASDAQ right now is looking at putting in like a crypto market that's underneath its traditional market. Once those types of markets are established, then I think it's easier for institutional markets to come in and create dark pools and things like that, where they can actually conduct transactions knowing that they're relying on prices that are reliable, as opposed to the result of people trying to maximize the prices without actually conducting real trading. So once that happens and institutions can come in, then we're going to see a lot more liquidity and more stable prices, a lot less volatility. So I think it's really not the regulations have worked for a long time with a lot thinner markets than this. I think what it really is people have to realize that real businesses have to be the underpinning of what gets traded, whether it's crypto or not. You're not going to have a substantial trading pool just like you're on the OTC bulletin board. You don't get much of a trading pool until you have something that becomes established.
And Sergei, on the tax side, does the existence of a secondary market make a difference for issuers? And if it doesn't, what about for investors? How should they be thinking about that?
Very good question. Unfortunately, the IRS has not issued much of a guidance lately. I think the last time they came out with some clarification was about 2014, and so there's not much distinction in the IRS guidance between utility tokens, security tokens, a general cryptocurrency. So from the secondary trading perspective, first of all, both security and utility tokens would still be treated as property. The IRS right now would not recognize any kind of like-kind exchange treatment for any property other than real property, so any exchange will be taxable. Also important to keep in mind that even though for certain purposes it may be possible to take a position that the security token could be treated as equity, but for purposes of investors exchanging digital tokens, whether they're security or utility, there won't be much of a difference at this point.
And on the exchange point, when we see real estate security tokens right now, they're all held through entities. People talk about holding the real estate directly, but really you're holding an indirect interest in the real estate. So when you're talking about like the 1031 exchange, that's not going to work for what we're currently seeing in security tokens, right?
Right. I would agree with that.
Wouldn't that be nice, though?
Yeah.
Yeah.
Justin, what about from your perspective? Who is it in the security token ecosystem that needs to be doing kind of KYC AML in the secondary market, and what kind of are their obligations?
Yeah, so I mean, I am not a lawyer, and I would encourage anybody that is issuing a security token to talk to their lawyer about this, because they're the one that can give them the specific guidance for what they're doing. But at a high level, the answer is unfortunately like everybody has responsibility for it, which is, if you're the point of transfer, if you're operating one of these ATSs, right, you're responsible for doing KYC and AML of the clients that are operating on your system and around the transactions that are happening on your system. But then also, if you step back a level, again, as Alexandra spoke about earlier, as the issuer, you're actually responsible for ensuring that there are appropriate controls in the secondary market. So, one of the things that was true in the utility token space and has been true in the crypto space is the idea that, hey, these tokens are freely tradable. I can't really control what happened after I issued them. They're decentralized and off they go to the races. That argument just doesn't fly with the SEC, because what they'll tell you is then, well, don't issue it that way, if that's the case. And so, you definitely have to think about and plan for how that secondary trading is going to occur and where it's going to occur, and how you ensure that the platforms that your token is going to be trading for do have the appropriate controls in place around KYC and AML, and that you've built the appropriate controls into your process to ensure that there are not material volumes of trading occurring outside of those locations that are controlled. Right, so again, if I go back to a traditional securities world, if I'm on an ATS, there's a lot of KYC and AML that goes on in place. There's not really necessarily KYC and AML that's going on if I hand you an Apple stock certificate, right? And that was really considered okay because the volume of that activity is so low that it doesn't pose any kind of risk to the system. right? Many people have said, for example, like a decentralized exchange is just the same as if we were trading those papers back and forth. However, the materiality of the volume changes that equation or may change that equation from the perspective of the regulators that are looking at the activity. And so I would just, in some cases, as you're thinking about things in the secondary market, just be careful about the parallels that people are drawing for you and ensure that they're appropriate for the activity that's actually occurring.
What are your thoughts in terms of secondary market participants exchanging KYC, AML, or sharing KYC and AML information amongst them rather than each doing it separately?
So from a personal perspective, I'm all for it. Unfortunately, in most cases, the law doesn't apply to that today from a couple of different perspectives. One is that, again, I'm going to speak from the US perspective, but this works in many other jurisdictions as well. They don't actually say if you've done these 7 check boxes, you've done KYC and you're good. And if they did, then I could possibly say I did those 7 check boxes. I trust Justin to do it right. So he said he did them. I can trust that. We can go after the races. What the regulators have actually said is that you need to have done appropriate KYC and AML for the specific risk of the activity that would occur with your token or on your network. And so what that means practically is that each company and each issuer needs to come up with a policy from the ground up of what their activities are. And the chances that randomly all of those would exactly match with each other is infinitesimally low if they're actually independently generated. The second thing that comes up, because there are actually some jurisdictions that are looking at creating legal frameworks to do this, Bermuda being one of the legal ones, and I actually was leading ones, and I've actually been speaking to the folks there. And there what they're doing is actually trying to come up with a framework that says, yes, KYC and AML data can actually be shared as a way to support the security token issuance. The barrier they've run into so far was, well, hey, okay, there's an issue around liability of that KYC and who holds the liability if it went wrong. And Bermuda's immediate response to that was like, we know insurance, right? And so we can just insure away this risk, right? Unfortunately, the liability is criminal. And, there's not a way to insure against going to jail. Like, you can't send a Bermudan to jail on your behalf.
Be nice, right?
If those laws were broken, or even some of the criminal financial liability risk. And so today, the way that the laws are written, or the way that I've at least read or interpreted them, and most people I've spoken to have, is that unfortunately, the legislation and regulation is not written in a way that supports reusable KYC and AML, although there are investigations in numerous jurisdictions trying to move that forward.
Yeah. And then one of the things we see with security tokens, and it kind of stems out of the utility token world, but it's really interesting that it's come towards security tokens, is kind of more creative structuring of the security itself. Historically, people sold equity. They didn't really sell a right to revenue, for example. Or what you're seeing sometimes is companies essentially mimicking the equity, but not actually having the board issue the equity. They basically say, hey, you have all the economic rights of the equity. It's just not equity being issued. When you start getting into those kind of more creative structures, how does it change things for you from a legal perspective? Like, how do you feel about that? I think there's also an investor component to it, as in how comfortable are investors with seeing something differently. How do you feel about those,
like having
those
a
types
board
of
approval
securities?
before having a board approval for it, but not actually doing an issuance, or having it?
Sure, you could issue a security that says here's a right. We're going to give you 80% of our revenue for forever, or we're going to give you a share that gives you a right to all of our profits and a right to receive liquidating distribution, notwithstanding the fact that you're not actually issuing equity in the company. Is that cause for concern, or is that just another security and that's fine?
So I think it depends entirely on how it's structured. I am actually for creativity in these kinds of things. I think that a lot of companies won't be able to find the talent that they need, and they won't be able to conduct operations, especially in an area that's very technically dense, and there are not that many people who are as good at creating these things. So I think that trying out new structures is part of business, and it's just something that people need to weigh the risk. You have to know what the risks are and then make sure that that is something that you're comfortable with. I think a lot of things like innovative structures in terms of offering something, not necessarily to a large group, but like an employee, offering them a cut of revenue in exchange for work, that those are the things that make business possible. So I would be wary of doing something long term. I think that the other problem that we have are security tokens that are not really, they try to be securitized tokens, but they're improperly conducted. So if you're trying to say that you're doing an offering of real estate and you want a revenue stream of, you're going to get X% as a token holder of the ongoing revenue, most of the time what I've seen has been that the finance documents haven't been there. And the problem is if you don't do proper financing, then there's nothing stopping people from saying, you know what, we're not going to take rent for the next year, or we're going to change what token holders get. We're just going to authorize token holders to get something else instead. Like instead you're going to get, like net profit instead of, gross or something like that. They can change the terms. There isn't the documentation there properly attaching and collateralizing whatever it is that you're going to do with the revenue stream. So the upshot is be creative, feel free to be creative, but make sure that all your underlying documentation is there, because investors are unhappy traditionally with things being changed on them. And if you get enough of them, you're not going to be in business anymore or again. And if you get enough people who are upset, then you're looking at derivative action. The benefit of having traditional securities is that those rights are already locked into the type of security that you're offering. With these, you can be super flexible, but make sure you're doing it completely and legally in order to make sure that they're attached. And the one other thing is, I just wanted to comment before I forget about the comment that you made about transactions with, if they're not entirely legal, but there's not enough volume. The SEC doesn't actually look at it that way. If you did something, if there's one, it may not rise to the level of reporting, say, but if you have something that is an improper transaction in the past, the SEC can go after it, and then you can face rescission for everything in that class. So be careful.
Yeah.
Sergei, what about from your perspective? Are there risks when you're trying to create some new securities?
Sure. Well, I think creativity is great. I think as long as it helps, facilitate your business needs. From tax perspective, the rules tend to be fairly rigid, and you have to determine how to characterize, a new creative type of security. What is it going to be? Is it going to be an equity interest, or maybe a debt interest, or something else? So from the perspective of the issuer, it could have huge importance, because it could be the taxable issuance of something that's not a stock or security, or it could be something that's completely free of tax. Also, you have to determine how to characterize the payments, reporting of the payments, and compliance in terms of reporting those payments to the service and to the investors. And so the investors will have to determine how to report what they receive, the payments for tax purposes. So I think there's a lot of complexity. I think with all the creativity that we see around in the market, it's important to keep in mind making sure that we address the tax issues along the way.
Is it fair to say that you really have to focus on the specific rights that you give security token holders?
Right. I would say it's important to define the rights, and also it sounds like, if you intend to change the rights, you need to think about what's going to happen to the issuer and to the investors along the way, whether it'll be a taxable exchange if you completely change the rights that you issue to your investors.
So Justin, you've talked a few times about KYC AML being kind of risk-based. So you're still issuing a security, but now it's a little bit more creative. Does the risk change for your purposes?
For the stuff that we're doing, that actually doesn't really matter at all, to be perfectly frank and honest. The one thing I would say if I was an entrepreneur that was looking at issuing a security that might have some unique features and aspects to it, you know, if you're issuing a traditional security that's kind of like right down the middle of the pike, you kind of, the world around you has taught you what the pros and cons and the risks to your business of that particular set of decisions is. And so the amount of risk analysis that you need to do around what happens if we're successful, what happens if we're not successful, what's the middle case, and what all that modeling looks like in terms of the money that goes to you, the money that goes to the investors, what does that leave aside? You know, the more creative that you're getting with the way that those things work, the more modeling that you need to do on your side to make sure that under the various conditions that might happen to the business, that you have what you need to get through. So that would be kind of the one warning I give, but that has nothing to do with what we do as a business, just something I would put in my mind as a founder. Sure.
And so one of the things that that's traditionally always happened is employees, consultants, advisors, directors, they're issued equity in companies. Is that something you can still do with security tokens? How do any of you think about it differently when you're dealing with security tokens instead of traditional securities?
So you can get tokens. You have to be careful of the amount and what your role is, and that it doesn't actually impact, like as the advisor or the attorney, you have to be careful that it doesn't impact your judgment, and that you are not going to treat good and bad news as you would if you were independent. Sometimes it requires disclosure. And the one thing, though, that came out of I guess that was clarified with the no action letter and the framework that came out is employee compensation is actually also removed from consideration in terms of your 12G reporting requirements. So basically, if you have 10 million in assets and 2,000 holders, you're required to register with the SEC, even if you don't do an offering. But they've excluded anything done under employee compensation from that number of holders and assets.
That's a good point.
Good. Well, on the tech side, I think you can get pretty close to kind of equity type or stock type treatment with the security tokens. I think it does create some uncertainty, but I think everything is about how you structure the features and characteristics of the asset. And I think it should be possible to get the tax treatment that kind of mirrors the kind of stock treatment for compensation treatment as well.
And I assume, how are you looking at it? I mean, are you even involved when you've got a company that's going to issue equity to an employee?
Yeah, I mean, I would say the only way that we've been involved is we've, run into something similar where we've had companies that have offered us tokens as part of our compensation. Sure. And we've been concerned as a company operating in compliance that might misalign the incentives. And so we've typically shied away from that sort of thing just as a way to ensure that there's not ever any question about where the decision making is and what we're making our decisions based on.
Great. All right, well, our time's up. Thanks for listening.
Thanks, everybody.